And I promise you guys, I would go live and talk about this particular topic. The bill's going on with you. This topic, before we really dive is something a lot of us don't know too much about. In this market, appreciate you, the bill. In this market today, you got to get creative based on how the real estate market is. As you guys know, I like to invest. I like to take risk. I like to trade stocks. I like to really dive into things to make some money. But I'm also here to make sure I teach you guys how everything works, my mistakes, my experiences, so you can learn from. One of the things is if you're a beginner or if you're an advanced investor, you're going into the world of real estate or you're already in the world of real estate, as the market shifts based on interest rates, you have to get creative when it comes to investing. And you got to really think about, okay, well, what are other tools that I can use to be able to invest? Well, one of the things is that I'm going to talk about today is especially for first-time home buyers, okay? For a lot of you, that's first-time home buyers, that's FHA buyers, VA buyers. This tool that I'm going to talk about today is a tool that exists. A lot of people do not talk about it because it's not for all types of deals, but it's very beneficial, and I hope a lot of you really take time to understand the value of it. Today, we're going to talk about assumable mortgages. A lot of you know when you're buying homes, you usually hear somebody say they're getting what we call an FHA mortgage, which is putting 3.5% down, and the bank finances you the rest. Another type of mortgage that you hear a lot of people talk about is conventional mortgages, meaning you're going to put 20% or 10% down. Anything above 3.5%, that's a conventional mortgage. Usually, it's 20% down. Today, we're going to talk about what we call assumable mortgages. And the reason I want to talk about this is because we got to really think about it. We're in a market right now where interest rates are roughly 7 to 8% based on your financial situation, based on your income, based on your credit score. And a lot of people are complaining they cannot get loans, they cannot afford mortgages. So in moments like this, I like to step in and kind of say, okay, well, what are unorthodox ways that you can actually dive into the world of investing or buying your first home with the tools that exist? We're going to talk about two of them. I'm going to give a bonus for the investors, and I'm actually going to focus, of course, on the primary, which is assumable mortgages. Now, think about this. Imagine you're able to get right now, for a lot of you that may not believe this, you're able to get a mortgage right now at 3% or 4% or 5%. You're probably wondering, how is that even possible when rates are currently at 7.5%, 8% based on your income, your credit score, and your whole financial situation, especially for first-time home buyers, VA and USDA buyers. I want you guys to understand there is something called the assumable mortgage. A lot of lenders are aware of it. A lot of lenders do it. It's not something that's publicly talked about, but it's very beneficial, especially in this type of market. So I'm going to talk about the pros and I'm going to talk about the cons. And if you guys have any questions, feel free to dive on in. Now, I want you guys to understand, okay? A lot of us are programmed to only what we hear and what we see. FHA, conventional. FHA, you're putting 3.5% down. Conventional, I'm putting 20% down. An assumable mortgage is essentially this. Bobby wants to pretty much take over or assume somebody else's mortgage. We all know 2-3 years ago, mortgage rates dropped down to roughly 3%. Some people even got 2.95. Some people got 3.5%. What about if I told you, though, there's some people right now that have mortgages at 3%, 4%, 5% that want to sell their home? Why, you ask? Well, at the end of the day, you got to really think about it. They bought the home at a certain price point. Sometimes the home has equity already. In the last 2 years, homes have been still going up because there's a big shortage in the real estate market. So you got to think about this. A person comes in like myself, by theory, who do not have a home. I find a seller who wants to sell their property. Example, home costs $300,000, okay? But it's worth $400,000. I'm going to give you the pros and the cons. The pro is I could actually take over this person's mortgage at $300,000 at the 3% interest rate if I do an assumable mortgage. Meaning, let me explain to you how it works. You're going to go through the lender that they have gone through to get the mortgage. You got to get pre-approved just like how they got pre-approved to make sure you can financially afford it. And if it goes well, guess what? You have taken over their mortgage But you ask yourself a question. So hold on, Bobby, that would mean I have to have a good credit score. I'd have to have the 3.5% down, correct? You would have to have your income where it needs to be, correct? Because remember, you're still going to go through the underwriting process just like the seller did, because you have to go through their lender, because their lender is the one who is going to transition the mortgage over to you as now the new purchaser. So you have to go through the underwriting process just as good as they did. Now, I want you guys to understand, this is a tool, and no tool has only positives. There is negatives. I want to give you guys some pointers and some gems you got to pay attention to in this particular live also. You got to really think about this. You're taking over a person's mortgage. They bought it at $300,000. We're going to use this as an example. The home is worth $400,000. You're like, well, Bobby, this is so easy. All I got to do is pretty much get pre-qualified through their lender, and I can take over their mortgage. What's in it for them? Remember, in this example, the home was worth $400,000. You got to understand, the seller wants their $100,000. The negative aspect of actually assuming a mortgage is you have to pay the difference of what they purchased it for compared to the equity that's in it of what it's worth today. So if they bought it for $300 and it's worth $400, you would have to come out the pocket and give them their $100,000. Because at the end of the day, you assume the mortgage for $300, but that $100,000 worth of equity, the lender is not going to take any chances on that. You need to pay out of pocket. They're just transferring the mortgage to you. So now you ask yourself a question. How do you play this game smart? Well, if I were you and you're a first-time home buyer, FHA buyer, VA buyer, USDA buyer, so what I would say is, hold on. Let me find sellers who don't have too much equity, very low equity. Meaning, hypothetically, they bought the home, I'm going to use $400,000, it's only worth $415,000. So now when you assume the mortgage at $400,000, you only got to come out the pocket $15,000 plus your 3.5% down. And for some of you, that's very affordable. And the good part is you get a 3% mortgage or a 4% mortgage. Because a lot of people that bought homes in the last 2 years, 3 years, were able to get loans at 3%, 4%, 5%. They, for whatever reason, don't want to be in the mortgage anymore. They want to roll the mortgage over to somebody. So at the end of the day, you can be that somebody if the person's lender accept assumable mortgages. So now you're going to assume the mortgage and pay the difference. For a lot of us, you got to understand, if you already have a property, this does not work for you. This does not apply for you. Because one thing about assumable mortgage is another negative. It's not for investors. It's not for anybody who already owns a primary home. So you cannot assume a mortgage on a secondary home that you own. It's only for primary first-time home buyers. So for a lot of you first-time home buyers that's complaining that interest rates are very high, this is a great option to leverage. But if I were you, you need to leverage a property or a seller that has no equity. Because remember, once the mortgage is assumed, is transferred over by theory to you, you have to pay the difference of the equity. In the example, like I stated before, if the home was worth $300, you assumed it for $300, but again, the purchase price was $300, but it's worth $400, the ARV. Guess what? That $100,000 difference, you have to pay out of pocket. See, assumable mortgage is not something a lot of people talk about because it's a very unorthodox way of transferring over ownership in a way where it actually makes sense, but it's only for certain type of people. If you are a first-time home buyer, if you're an FHA buyer, if you're a VA buyer, assumable mortgage is a great tool to use. But again, you ask yourself a question, well, Bobby, I first have to find a person who wants to sell their home. Yes. Second, remember, do not go find somebody who has a lot of equity in their house. Because if they have a lot of equity in their house, you have to pay the difference if you're going to assume that mortgage, which can be very costly for a lot of people. I want you guys to always think about that. Now, I see a question. I'm going to answer this question momentarily on, I think that's YouTube or Facebook. I'm going to answer that in 1 second. Now, a lot of you need to ask yourself a question. Rates are currently at 7%, which is very high. 7.5. If your credit is horrible, maybe 8.5. That's how bad. Heat locks are some of them are even 10% right now, which is crazy. That's 10% compound, which is crazy. For a lot of you that's first-time home buyers, that's trying to figure out how do I buy my home in this market, it's important that you leverage a tool that's not talked about from a lot of lenders. It's called an assumable mortgage. You're going to take over somebody else's mortgage. But remember, the negative to it is if the property is worth more than what the purchase price is, what they bought it for, or what they're selling it to you for, you're going to have a problem because the difference you have to pay out of pocket. So to make this example very simple, you're assuming the mortgage at $300, but the ARV, it's worth $400. You would have to come out of the pocket $100,000 plus 3.5% down, because remember, just because you're assuming the mortgage, you still have to go through their lender and go through the underwriting process to make sure you're approved and you're verified and you can afford the mortgage that you're about to take over. So I'm going to take a question before I talk about the second loan. This is more for investors. And the reason I'm giving these two loan products is because as I'm investing, as I'm buying properties, you're going to need a lot of lenders. And lenders do not like to talk about anything else except FHA and conventional. And if you're lucky, they might talk about a hard money lender. They do not talk about none of these loans that I'm going to be talking about today. Let me answer this question. K West says, hey, Bobby, can you do that in lieu of refinancing if you're currently on a mortgage? No, you cannot. That's a very good question, a very good thought process too. I like that question. See, a lot of you, I like how she thought to think about that. So instead of refinancing, can I just take over somebody else's mortgage? Because you got to understand, they're still looking at your debt to income ratio. And that's going to affect you because you're currently in a particular situation right now. A lot of you need to understand it's important to leverage different tools that exist. The second loan tool that I want to tell you about that a lot of people do not talk about is called a DSCR loan. Imagine this. Bobby's an investor. He wants to buy a property. For a lot of us, we know somebody, or we're probably in this particular situation. Our tax returns are horrible. There's not enough income, even though our savings account or checking account have a lot of money in it. But our tax returns are just not where it needs to be. Well, there's another loan. It's called a DSCR loan. It's a very conventional commercial type of loan. And what they will do is they will finance you not based on your income, but based on the cash flow of the property. So they're going to base it on, well, how much is each door collecting in rent? Hypothetically, it's 3 doors. So you have 3 doors, a triplex. You're collecting $1,500 per door. But the problem is your tax return income don't show enough money. But you got enough money to buy the property, to put the down deposit, but your tax return does not show enough money. How do you buy this property? Well, ask your lender about what we call a DSCR loan. What the DSCR loan is going to say, well, if the property has a cash flow, we could give you a loan based on the cash flow as long as it could pay the mortgage we're about to give you plus a quarter of it. So let's say the mortgage was $1,000. What's a quarter of $1,000? $250. So based on the person that's paying rent, can this particular situation, property that you're trying to buy, pay $1,250 a month? If it can, you do not need to have income on your tax return. What we only care about is, do you have enough money to close on the deal? Do you have the money for the down deposit? And is the property able to cash flow what the debt service, aka the mortgage, is about to be? See, these two loans that I'm talking about today are loans that a lot of people not going to talk to you about. See, one of the things I always tell you guys as I'm educating you, give you guys my experiences, I'm learning too and going through these experiences of different type of ways to be creative. Because one thing you got to understand, people, even though I'm sitting on a certain type of money, it's still not enough to take down 20, 40, 50 properties. And you guys got to understand, as you're really buying property, you're really getting into investing. You have to get creative with how you invest and how you take down a property. For a lot of you, you're always going to think, well, the only two ways to get a loan is to either go to a bank or go to an MLO, mortgage loan originator that you probably know or see online. And the only thing they're going to do is talk to you about two loans, FHA and conventional. They're not going to talk to you about, if you're a first-time home buyer, in today's market, you don't want to buy a home at 7%, 7.5, 8%. You could do an assumable mortgage where you're taking over somebody else's mortgage who have a mortgage at 3%. You're going to get underwritten. Of course, you're going to go through their lender who gave them the loan. And if you get approved, they're going to transfer the mortgage over to you. Like I stated earlier, for some of you that just tuned in, the negative about this is do not buy a home that has equity in it. Because if the home has any type of equity, example, hypothetically, you're buying a home for $300,000, but the home is worth $320,000. The negative aspect of assumable mortgage is, yes, you're going to assume the mortgage at $300,000 at 3%. The mortgage is now going to be transferred to you at $300,000 at 3%. But hold on, the person that's selling to you realize their home is worth $320,000. That $20,000 difference, you have to pay it as the new owner out of pocket. The lender is not taking care of that. They're only going to transfer the mortgage over to you, just like transferring a car payment over to somebody else. You got to think about that. So if you're going to do an assumable mortgage, it's important to understand, do not try to buy a home that has equity from a seller. You want a home that's undervalued, believe it or not, or it's at a break even. What they owe and what it's worth is right there. Perfect scenario. Because at the end of the day, you can't get hurt and you don't have to pay nothing out of pocket. The second mortgage we spoke about today, for a lot of you that are not first-time home buyers, that already have a first property, you got to start figuring out ways to buy properties. Well, sometimes your income is not good. What other ways can you buy properties if your income is not good? There is something called a DSCR loan, where the loan is not based on your income. It's based on the cash flow of the property. If it's a triplex or a duplex or a quadplex and it has tenants in it, the tenants are paying, hypothetically in this example, $1,500 a month. That's $4,500 a month. As long as the mortgage that they're about to give you, which they're going to give you the numbers based on how much money you're putting down, as long as the mortgage can service 1 times a quarter of that mortgage. So let's say the mortgage was $2,000. $2,000 times a quarter, which is $450. So as long as the mortgage can, of course, do $2,450 based on the cash flow you're collecting, you can pay that. They will give you a loan based on the cash flow, not your income. And of course, a lot of you run into this situation. I get a lot of people that DM me about this. Oh, Bobby, I'm trying to buy a property, a second property or third property, but for some reason I ain't got the proper tax returns. You don't need it if you're doing a DSCR loan. Now, there's another loan we'll talk about in another live, where the loan is strictly based on, they're going to use whatever you have in your savings for the last 2 years divided by 24 months. And they're going to base that as your income. See, I'm learning so much about these loans because I'm doing it. Because one thing about this world is only going to teach you what they feel like they want to teach you, which is FHA and conventional. They're never going to talk to you about DSCR loans. They're not going to talk to you about assumable loans. They're not going to talk to you about loans that only focus on how much money you have based on your account in the last 24 months. And a lot of lenders don't even understand these type of loans. I just called Quicken Loans yesterday. The reps say, I've never heard of these things before. Imagine. While I'm talking to a whole different company, and they're like, yeah, we do it all day whenever you're ready. Which one of these type of loans are you looking for? Just to show you people, it's important to do your research. It's important to use your mind when you're buying properties and using the right tool based on the economy that we're in. Right now, the economy is terrible. Rates are very high. Mortgages are very high. Home prices are very high because there's a big shortage of homes. Right now, at one point, you could have bought a triplex, meaning 3 doors, for $400,000, $200,000. Now, triplexes, based on if it's a 3-2 or a 2-2, they're going for close to $1 million right now in the Tri-County, Florida area, meaning West Palm, Boca Raton, Broward County, where we talk about Miami-Dade. Don't even talk about Tampa and Orlando, even worse. Right now, people are selling quadplexes, meaning 4 doors, for $1.2, $1.5 million. When in 2008 or 2010, 2012, after the crash, these quadplexes was going for $150,000, $200,000. Now they're going for 1.6 for 4 doors. For a lot of you, I hope you're tuning in. I hope you're listening, because as you start to dive into investing, you have to get creative, and you have to start learning how to utilize tools that make sense based on your particular situation. Utilizing an assumable mortgage or a DSCR loan, if you're an investor such as myself, is going to be a great tool as long as it makes sense and a cash flow property. For a lot of you first-time home buyers that's complaining about these expensive high rates, don't worry about it. Just do an assumable mortgage. Find a seller that wants to sell you a home, assume their mortgage, especially if they have it at 3%. They bought it 2-3 years ago during COVID. People, beat the game. Play smart and invest wisely. Mentourme.com. You guys enjoy your evening.